Welcome to Decoding Growth, where unfiltered conversations and bold ideas are reshaping retirement. Each episode cuts through the noise to reveal the strategies and unexpected alliances driving real industry change, one conversation at a time. Here are your hosts, Lisa Kottler and Will Prest.
Welcome to another episode of Decoding Growth, where we dig into the ideas, the partnerships, and all the innovation that's reshaping our retirement plan industry. Today, we're excited. We're talking with someone who sits at the very top of that change, a leader whose decisions really ripple across millions of savers, thousands of advisors, and really the entire ecosystem.
So our guest today is David Musto, Chair and CEO of Ascensus. David has more than 3 decades of leadership experience in retirement, investments, and insurance. Before joining Ascensus in 2017, he held senior roles at Great West Investments, Empower Retirement, JP Morgan Retirement Plan Services, Prudential, Cigna, and not to mention time leading a financial software startup. Since becoming CEO in 2020, David has overseen Ascensus's massive growth, including the landmark acquisition of the Newport Group, new partnerships, and continued innovation in record keeping, 529 plans, HSAs, and much, much more. Under his leadership, Ascensus now administers over $860 billion in assets for more than 15 million savers. Simply put, he's one of the most influential executives in our space.
Clearly.
Boy, that's quite a build-up, team.
Isn't it? You got a lot of those.
Well, hey, it's very impressive. In fact, I guess we were so intimidated, we didn't even introduce ourselves. I'm Lisa Kottler, and this is my business partner, Will Prest. But again, David, we're very excited to have you here. And we're going to really talk to David about really 4 main areas. We'll talk about, where is the industry heading or where he thinks it's heading, how do big brands like Ascensus really evolve, how he thinks about innovation, especially inside of a large enterprise, which is its own challenge. And for all the founders and the founding teams who are listening today, we'll also get his advice on what he thinks startups should know when they're approaching an industry giant like Ascensus.
So, Lisa, I think it's a really rare chance to hear from somebody at the top of the game, one of the biggest players, and see what you think about and your company thinks about sort of the next era of growth and what it might look like.
So, David, Ashley, welcome to Decoding Growth.
Thank you. Really excited to be here. Really appreciate you taking the time on these topics that I think are really important for our industry broadly, right? As we think about the evolution that's happening and how we all work together, band together to create better outcomes for American savers. Really important purpose and mission that we have.
And for me and Will as well, because that's the whole reason that we started this podcast. It was really just an extension of the workplace retire tech map that we published last December, and then our follow-on report, the Next Gen 401k report, because it does feel a little bit, David, and we'll start with really kind of the future. And let's think about where we're heading, and then maybe we can talk a little bit about how we think we'll get there. But, as we just talked about, like, some would say that retirement is really at a crossroads, or I would say maybe even an inflection point. We still have coverage gaps. 9 out of 10 employers still do not offer a 401k plan today. We have demographic shifts. We've got the rise of emerging tech. Consumer expectations are ever changing, and there's probably some other factors as well. So which forces do you think will really most shape our industry over the next, say, 5 years or so?
Yeah, and let me start by saying congratulations. I think the report that you both pulled together and the insights that you pulled together is really helpful and really nicely frames a lot of the various forces that are playing out in the marketplace in the industry right now. I guess I come at it from 2 different perspectives. The first is, how do we improve the opportunity for savers to be more successful as an industry? The way we think about it at Ascensus is, how do we help more savers save more? And then the other dynamic, which your work speaks to as well, is what are the dynamics at play across the provider ecosystem? Maybe a little bit of inside baseball, but really important to understand those dynamics as we think about creating better outcomes and success for American savers, and also improving the landscape for many of the constituents that we serve. Maybe just starting off with how we improve the opportunity for savers. You talked about this coverage deficit. We've always talked about it in terms of twin deficits. A lot has been written about and spoken about all the statistics of coverage and the lack of coverage, particularly for American workers in small, mid-sized business. That's where and the gig economy, right? That's where the big opportunity exists. But there's a second deficit around quality. And when you look at not only those small and mid-sized businesses, but even some larger businesses, you have certain plans that have lower levels of adoption of auto features, enrollment, escalation. Therefore, you see less participation. In general, lower contribution rates in small, mid-sized businesses with lower average salaries. There's this quality issue that's also materially important as we think about guiding people to the right outcomes. This is something that is really important to me personally. I saw it firsthand in my own family. My father's family were Italian immigrants, didn't have a lot of money. My father sold peanuts at the Bronx Zoo to put himself through technical school. And he was fortunate that he got a job at Bell Labs, one of the biggest engineering innovation institutions at the time. And he had access to a defined benefit program and ultimately a really strong defined contribution program and health programs and all those aspects of what it's like to work for a high quality big employer. His brother, my uncle, was an incredibly successful small business leader and entrepreneur. He made 20 times more money than my father made throughout his lifetime, but he ended up toward the end of his life living in a really challenging way as a function of a healthcare event and had very little money at the end of his life. And you look at the difference between my dad and my uncle and their outcomes just as a function of who they worked for and the programs that they had access to. So it's a really big deal. And I think my own personal story is illustrative of what many other people are experiencing in their lives. The barriers to getting these programs to adopt, or it's all about administrative complexity, cost, and fiduciary responsibility. Where we see things headed and where we're focused here at Ascensus is really in three major areas. One is how do we make workplace plans a reality for even more businesses? Right. I think part of that is a broader range of solutions and capabilities that you can deliver at scale that meet the needs of the various types of businesses that we serve, whether those be PEP solutions, where we're able to provide fiduciary support, SEP-simple IRAs, individual Ks, regular defined contribution 401k programs with a variety of features. We believe that having the right solutions for the right workplace is really an important part of it. Another big important part is lowering cost, lowering administrative burden, and providing more support around fiduciary risk. Technology and client experience, we think, is at the core of that, because if you deliver the right client experiences, you can very efficiently deliver very high quality outcomes. That is, I think, absolutely critical in that small market. And then the third area that I would point to is, or the next area I would point to is saver participation and increasing contributions in programs. We need to get people in these programs more efficiently. We need to help them better manage their period of saving. We need to help them track and manage their programs. We need to democratize advice, removing the obstacles to saving that exist for so many Americans. And at the end of the day, we need to take a really saver-centric approach to the way we design our solutions.
It's really interesting. The key way that you talk about the industry and your goals, it sounds like we read your mind ahead of writing our paper, because what Lisa and I did is when we sat back and said, what's getting in the way of industry growth? We looked at access to plans in the first place, participation, boosting engagement, better outcomes. So that's kind of fun that we're all synced up. And we looked at that because we just want the industry to have more coverage, more savers, get bigger and get better. With that, Do you think the consolidation amongst record keepers is helping that or hurting that? And does that leave room for specialized players? And how do you see that? Because you're a really big brand, and yet you're very focused on using your brand power in this smaller plan space and the gig economy, which is where there's so much opportunity for coverage, but isn't there yet.
Yeah. You two wrote about this in your paper. I think it deserves kind of repeating. We're living in a world where there's a lot of creativity and innovation around specific solutions for savers, whether it be emergency savings or college debt or approaches to advice, institutionalized investment capabilities. Lots of innovation, which is serving the industry well, and I think serving and savers well, but it's really confusing at the consumer level. And what hasn't been done as well, and what we're very focused on at Ascensus, is how do we integrate these experiences, these solutions in ways that can be consumed successfully by the saver, and also where we can manage partnerships and relationships across different capability providers so that everyone's benefiting on the platform that we're creating and delivering in the marketplace. We really think the winners will focus less on point solution manufacturing and more on creating value for savers through a network of partnerships on platforms that are informed by data to better deliver holistic experiences, right? That's really at the core of what we call a saver-centric sort of approach and a platform approach to delivering in these models. To your question of consolidation, there's no doubt we're going to see more of that. We see the market starting to separate into some different models. There are providers that are built on the foundation of their asset management and wealth management capabilities and franchise. And the capabilities they deliver in the workplace helps to connect and drive more holistic success in those areas for their clients and ultimately for their organizations. You have other businesses that have as a foundation more of a human capital management or a broader benefits tilt in the way that they think about addressing saver opportunities and needs. And maybe a third category, I'd like to think that Ascensus is leading the charge in terms of independent technology-enabled platforms that, while we recognize the benefits of connectivity across asset and wealth management and human capital management, we're unencumbered by those business models in the way that we come to market because we're not owned by an asset manager or a wealth manager or an insurance company or the like.
Right.
Each one of those models has a great future because there's a set of clients and institutions that are going to benefit from the delivery of those models. But I don't believe there's going to be more than a couple of scale, successful, thriving, growing providers that are capable of winning in each of those categories. And so I guess we think about the consolidation not only happening in terms of the number of providers in the marketplace, but the types of models that ultimately are also consolidating or harmonizing in a way that is going to leave advisors and consultants and plan sponsors thinking probably as much or more about what model is best for their business versus looking at this overwhelming list of different providers, 40, 50 different providers, and having to figure out which of these do I like best.
Couldn't agree more. I really, with so much of what you said about the consolidation, about the point solutions, and I really love that you and your company frame this as a saver-centric. And I have to think it goes back to where you started, because you started this conversation talking about your family and how the personal stories of how they worked their lives and got to retirement. And it's probably a way that we all should be thinking about it as we build these solutions, making that sort of human connection. But along those lines, or maybe a little bit of the opposite of that, is there, I mean, I love the way you've described and framed how Ascensus is viewing this, but are there something that other legacy players, or certainly not trying to call anyone out, because you're right, we have different business models and they'll all thrive in their own ways. But is there something that we're underestimating right now as an industry as we continue to look forward?
Underestimating in terms of the ability of what you call the big brands to be able to evolve and innovate in the marketplace.
Right.
I think if you take a step back and you think about innovation in a variety of markets, whether that be sort of financial services or others, you see a consistent pattern where new entrants in markets tend to focus with a really healthy focus on an understanding of who they're trying to serve and what outcomes they're trying to create, are able to innovate and create solutions in today's world, highly digital, very effective from a client experience perspective, and start to capture a big share of a very small segment of the marketplace, and which really serves as the foundation for their growth and development and evolution over time. And oftentimes the entrenched players may not appreciate the value of that innovation or care that much about the segment of the marketplace that is being now dominated by a different set of players.
It's the Innovator's Dilemma by Clayton Christensen. That's it.
Yeah, exactly. You got it. Yeah. I should send him a check for what I just shared, because it was clearly the S curve, as we've all come to know and love it. But I won't use the name of a firm, but it was one of the firms I worked for before with a very compelling and successful chief executive who was able to observe that there's a lot of benefit to big brand, scale, reach, influence in a marketplace, and an ability for even larger, more mature organizations to be able to invest in very powerful ways, whether it be technology or service and operating disciplines or expertise and experience, in ways ultimately that enable them, if they have the right culture and if they have the right approach and thoughtfulness around innovation, that they can either partner with and or replicate many of the innovations that are happening right in the marketplace at any given point in time. So I think it's incumbent upon more mature firms, if we want to use that term, or big brands, as you say, to be very mindful of where the opportunities are and to think about their business very differently. And I'll tell you, at Ascensus, the term record keeping is a dirty word.
Really?
Like record keeping is the value that we bring to the marketplace, like being able to keep data on a system and keep it fresh and secure. And that's all important. And transactions and compliance and all those things are incredibly important. But as we talked about before, that really limits and I think devalues what we're all about and what we're trying to accomplish. We think a lot about the concept of a platform company. And if you think about in the sort of the technology parlance, these are organizations like Amazon, Venmo, DoorDash, right, that are leveraging technology and data and client experiences to facilitate more interactions and value amongst the participants in their ecosystem. And Ascensus, as a platform company, is able to very seamlessly, because of our technology and our service and operating disciplines and our expertise, bring together multiple point solutions and capabilities and serve multiple financial institution partners, multiple asset management partners, multiple wealth management partners. And if you think about this business model from a platform perspective, what we're really doing is leveraging technology and capabilities to create a bigger pool in which all of these market participants can come together, all aligned against that objective of helping more savers save more. And that becomes very powerful, not only in terms of the end outcomes that you can deliver for American savers, but in terms of helping each of those participants in the ecosystem build their business more successfully. You said we have close to 900 billion in assets under administration. I think we're a little bit over 16 million American savers today.
Very impressive.
Like the benefits that we can bring. Well, yeah, I mean, I've always been a big believer that, these big statistics are sort of irrelevant in the absence of being able to derive value for your clients as a function
Yes.
of those big statistics. And that is being a little bit long-winded here, but I think that's where the game's headed for Ascensus and for those that have the courage and the discipline to rethink their operating models and their business models and really move toward more of a sort of platform company kind of concept.
And it does take an element of courage, that's for sure. That's what Will and I see.
I love what you said about record keeping's a dirty word. It's a very complex industry, and we end up going to market with what we do and all the work that we're doing, but it's the opposite side of what's actually bringing value. So if you think put the saver first, you can probably make it a lot less confusing. So I just wanted to comment on that. I thought that was really cool. You guys are obviously doing a ton around thinking about the future and innovation. Could you talk about a specific pivot or examples within Ascensus about how you're trying to find these new opportunities, and maybe it's with new ventures or other partners?
Yeah. So it starts with rethinking what our company is and how we deliver value. So that platform company concept, and not that you'll see that in our advertisements out in the marketplace, but that way of thinking about the business, I think it starts there. There's no doubt that we're in a unique position, particularly with so much focus on helping to eliminate barriers to savings and also democratizing best practices in institutional investing and in advice and wealth management. We have a tremendous innovation opportunity to bring all that together for our clients and for our partners. And I think this is where our independence serves us well at Ascensus. We're in a position to help our asset management partners and help our advice and wealth management partners better engage and ultimately better serve our collective mutual clients. If we're talking about nudges or a client experience that injects some form of advice or extends a workplace relationship into an ongoing retail relationship, we're not looking to capture those opportunities for ourselves, but we have the technology and the infrastructure to help engage our partners in serving these 16 million savers. So that's something that frames some of our innovation. But like innovation has been in our DNA. We were one of, if not the first firm to really focus on price transparency and open architecture in the marketplace going back decades. More recently, we were innovators in the early stages of the 529 marketplace, the state facilitated retirement plan market, the ABLE market, very early to the game around PEPs and 316 and fiduciary capabilities. I think we were the first firm to incorporate and embed financial wellness into our offer without charging for it on an explicit basis. We're going to be leaders in finding ways to democratize private investments in our ecosystem. But the foundation of that really, and this gets to your map of sort of fintech and some of the real advantage that they have in terms of clean technology from which they're built. A lot of our innovation is focused on technology and back-end infrastructure. We were one of the first scale record keepers to recognize you need to have purpose-built technology systems for each one of the major markets that you serve. Don't try and lever a single system to serve all potential opportunities in a market. When you combine those purpose-built systems with really strong modular technology and digital interfaces, then you're able to really take advantage of the scale and deliver higher quality, more efficiency, more end-to-end ease in the way that our clients work. We were early and agile. I think we're leading the pack in AI, and that's going to be a critical area of technology focus in the years ahead, not only from an efficiency and quality perspective in the way we deliver service, but also as you think about enabling growth for our partners and also improving our own sales velocity internally. So a lot going on there. We're proud of sort of the DNA of innovation in this business, but we can't rest on those laurels.
If and when you're ready at some point, that could be its own conversation, is really to talk about the emerging tech and particularly AI and how that's evolving and the types of things that you guys are doing with that. But let's get to, as we talk about innovation, as you think about it, as Ascensus thinks about it, there are definitely some challenges. And we were talking about how great it can be and all the wonderful things you guys have done and are going to do. But it is, look, we're in a very, I'd say, one of, or maybe the most highly regulated industry, period, and certainly in financial services, because in addition to the other financial services types of firms, we also have Department of Labor and IRS, and we have so many regulatory bodies overlooking us. We have folks who are trying to create a federal plan. We have just so much compliance and laws and a fairly convoluted distribution system too.
Yeah.
So a lot that makes this very challenging. But how is it that a firm like Ascensus, how do you keep that innovation going? How do you balance what, presumably you have to be a risk averse organization in many ways, given the number of assets and the people and how serious this business is. But yet we want to innovate so we can improve coverage, so we can improve outcomes. So really, how do you think about innovation? How do you balance all those things as such a large organization with a lot at stake?
Yeah. First off, it goes without saying, one of our 3 core values, people matter, quality first, integrity always. We operate in a appropriately highly regulated, scrutinized industry, right? And it's all in the best interest of the end consumer, the saver. Unfortunately, we all heard Chip Mason, one of the icons in the asset management industry, the founder of Legg Mason, passed away recently. And he used to talk about this concept of being in an industry and in a business, use the football field analogy with the chalk lines. And not only do you want to stay on the field, but you never want to get chalk on your feet, right? So I do think businesses, big, small, big brands or fintech innovators need to be very cognizant of that. And I'll tell you, we've done a lot of acquisition very successfully. I'd like to think it's as important that we've been able to select the right businesses as much as our skill around integrating businesses. And, we benefit in both of those areas. But we've seen some fintech organizations that have built models that, if they were scale businesses, would be under very heavy scrutiny in terms of the chalk on their feet around certain approaches to the way that they manage those programs. And that's just not acceptable to us. It's not the way we operate. I do think it's going to be part of the crossing the chasm dilemma for some of the tech innovators to figure out how they can maintain the right disciplines at scale as their businesses mature and grow. How do we do it at Ascensus? Part of it is continually pushing the envelope on what kind of business are we? I talked about, we're not a record keeper, right? We're a product platform company. And I'll say a word on that, because I think that's not just about technology. It's not just about service model. It's not just about expertise. A lot of it is about culture. And this is where I think some of the finest examples in that fintech's chart that you put together really show themselves. They get their work with an intense focus and understanding of who their client is and what they're trying to do for that client, right? What experience are they trying to create? What outcome are they trying to create? And then everything in their business gets built around the support of that objective on an agile, continually evolving basis. And that is not historically how, not just in the financial services industry, but in other industries, it's just not historically the way larger incumbent operators, right, have thought, right? It's all been about waterfall, and it's all been about sort of leveraging existing capabilities and extending them versus really having that really extreme focused understanding of what you're trying to achieve and continually evolving it. So the good news, I think, for Ascensus, and I'd like to think there's others of scale in the marketplace that are getting this, that is, and the simplest answer to your question is, that's where we need to start. That's where we're pushing our culture. Those are the skills and experiences that we're hiring for as we bring new people into our organization. Those are the skills and experiences and perspectives we're developing our people for. And as we think about what our company looked like 5 years ago versus today versus 5 years from now, it's really going to be that gem of a notion that we think is going to have the most transformational effect on our business.
I love that kind of thinking. Yeah. It really is a mindset. And I think you nailed it. Small firms get really good at their audience and they're very close to the market because they're just trying to survive. And if they do it right, they add value. One of the things that Lisa and I have found in publishing the report and the map and the work that we're doing with new ventures and large companies is that there's really this orchestrated ecosystem. So the map pointed out there's a whole bunch of new ventures that are coming to market and are trying to succeed. Some you've known and you work with, and others are brand new. And next year's map will probably grow to something like 90 because it's just constantly, there's growth out there. One tact we take is the new ventures of many have come to us and said, help, in essence, they're saying, help us be market ready or help us be enterprise ready, meaning maybe it's Ascensus, but how do I approach a brand? Mm-hmm. So this is where I'd love you to sort of take the gloves off and be a great coach and say, if you're a new venture and you're coming to a large brand, and all three of us have worked at big brands, but you've worked at the top of several, what are the one or two mistakes that you see founders making? And what advice would you have for them, whether they're approaching Ascensus or another big brand or just an entity where they see a great partnership potential, but they're so blinded by how excited they are sometimes that they don't understand what you need. And that's the role that Lisa and our team have been finding is this Google Translate is that enterprises have needs and they have to be solved for maybe through a pilot, and new ventures have needs. Could you talk about that match, what you see, the mistakes?
Yeah, happy to. I guess I'd start with just observing maybe a couple of three themes in the marketplace that I think both fintech, new companies, as well as companies like Ascensus need to keep in mind. Number one, and I think this is even more the case post-pandemic than it even was before, because that was an accelerant to a lot of the themes in the market. Number one, there's a flight to quality. No one has an appetite for capability that isn't of high quality and delivering ease and outcomes. And there's enough players in the marketplace that are capable of delivering quality. You need to be there. Second is flight to value. I think the market has come to expect that you should not have to pay a premium to get quality, right? To get outcomes. There's examples of firms, and I think Ascensus is one of them, that are able to deliver some of the highest levels of NPS and client service in the marketplace and do it very affordably and very efficiently. And then the third, back to our earlier conversation, is just the dynamics of this industry transformation and consolidation that are happening. So I think, and on that point, as you think about the dynamics in a consolidating industry, and I am getting to your question, you've got to have scale that drives value and economics. You've got to have differentiated value, which is probably some combination of ease and cost, service, outcomes. You got to have a revenue and a growth model. You have to have an ability to operate successfully in the ecosystem, and in some ways in what do we call it? Co-opetition, right? Because a lot of our partners, we also compete with in some regard over time, and vice versa. And there's a certain DNA that's required to be able to do that successfully. And obviously you need to have the table stakes around data analytics, security, and technology. So those are like, as we take a step back and think about anyone approaching us for partnerships or an acquisition, that's where we start. And we look at, do they have a great experience that can actually scale, right? Maybe in partnership with us or maybe independently. You have to be able to deliver that great experience at volume and do it at increasing levels of complexity if you're going to expand your mode out to a broader addressable market. Number two, how's that firm thinking about extending its core competencies in digital experience to connect with human interaction? We believe strongly in this industry, in this marketplace. Digital alone, technology alone is not going to solve the problems and the opportunities of all these human beings. There are elements of human interaction that are required, maybe different elements that existed in the past, but still, this is a human business. They need to have a long-term perspective, even though they may have short-term objectives. They need to it's really helpful to us to see evidence that they've led through tough times as well as good times. And then at the end of the day, do they take care of their people and their culture and their people and their customers? Those are some of the cultural aspects that we believe are really important as we look for partners, as we look for acquisitions.
So let me ask you this. Will and I have both built startups. We've both been on that side. I think you've been at a startup too. It's the challenge when you're sitting on that side and you're trying to either, raise money or get strategic partnerships with the legacy firms. One of the challenges, well, there's many challenges, but one of the challenges is they say, well, we want traction. We want to see that, but there's not always clear distinction about what traction really means. And everyone has their own definition of that, whether it's an investor or a firm like yours. And, all these different, like on our map, the retired techs, the 60 that are on there and the potentially 90 that'll be on the next one, they're in various stages. Some are pre-seed or seed even, some are Series A, some are already at Series D. There's a whole variety there, and they all have different levels of traction. Could you speak to that a little bit in terms of your tolerance and appetite for what size firm you're willing to work with? And along with that, are you guys willing to potentially like maybe pilot or co-develop, maybe within some guardrails with a certain subset of customers? Is that something that you guys are interested in doing?
Yeah, certainly it all starts with, is that firm delivering some unique value in the marketplace that is the kernel that ultimately is going to drive the success of that business and or in combination with our business. And if we have conviction that there's a germ there, and in particular, if we have conviction that we can bring something to that party that helps accelerate it, helps optimize it in the marketplace, that's where we start to get really excited. I don't know that we distinguish. We're not a VC firm, strategic investments at certain stages of the development of a company. We're more on the hunt for opportunities to add more value to our clients and do that through partnerships that are scalable and unique and can really matter. Traction, though, and being a quasi-entrepreneur and being part of a startup earlier in my career, it was very clear the difference between companies that had a lot of beta out in the marketplace where customers weren't yet paying versus the companies that actually had people paying for what they did. Yeah. I think that's one of the first sort of signs of evidence that the marketplace really cares about what you're doing and values it. But to your point on piloting, yeah, like we're big believers in, back to all the reasons I described before, and the sort of the way we think about ourselves as an ecosystem, tech-enabled platform. You need to have a philosophy of let's test things, let's evolve, and let's see what works and what doesn't.
I think we've found we have a couple really good cases where I think using your criteria, there was a clear mutual win for both partners, and they figured out a pilot formula that didn't put the small new venture out of business, allowed the large venture to sort of let it run and see how it worked, but in a test, kind of a sandbox environment. It was safe, it was compliant, it was all those things. And I think everybody had a win. The enterprise invested some money. The small company helped make sure that they could bring something to market that was very specific. It was specific enough to that enterprise that it was a really good partnership all the way around. I don't know if you have thoughts on that, but there was sort of this master mutual piloting.
Yeah, I think that's healthy. I think that's where you learn. Yeah, so I just think it's a critical aspect. I'm fearful for organizations, especially with earlier stage entities that are just sort of writing a big check or placing a really big bet on something that hasn't been road tested in the marketplace. I mean, it's a philosophy that extends to even the way we're developing our own technology and solutions. We use a client effort score to observe how our clients are interacting with us digitally and through other channels. and where they're able to work efficiently and where they're not able to work efficiently, where they're gravitating to. I just share that to say testing doesn't mean just like throw something in the marketplace and see if people are going to buy it or sort of do a focus group or two. I think as an industry, we need to get much more disciplined and surgical around how we evaluate what's really working for clients.
Absolutely. Could not agree with you more on that. And we need to understand the problems to solve for the employers and employees that we serve. And we need to do, I think, a better job of getting to those, what the job to be done is, getting back to Clayton Christensen. But also to your point about bringing firms like yours together with some of these retire techs, either for partnership or acquisition. Will and I, as I said, we've been on both sides and we speak the language of both. So we sort of see ourselves as kind of a Google translator because it is a different language. And I think we've outlined here today just the differences. And so where the real magic can happen is when we can bring those two worlds together. When you can take the nimble, innovative solutions that these retire techs deliver, along with the distribution, the trust, and all that you've built, and meld those together, that's where the magic can happen. Very hard to do, much harder said than done, or done that way, whichever way that goes. And so it is really something that I know Will and I want to see more of in our industry, is really the coming together. But you're right, we have to be disciplined in how we do it. Well, we're so excited you've been here today. We would like to ask you one last question kind of off of those 4 topics. Well, it really does blend in. For the last, 5 or 6 months or so, it seems as though Will and I have really been pulled a lot inside into the TPA world in a whole different variety of ways. We actually have a digital TPA on our map, 401k in a box. There could potentially be others that come on the next version of our map. You guys obviously own one of the largest, if not the largest, in Future Plan. Just curious, we're seeing all the PE money come in. There's a lot of interest, a lot of talk around TPAs. Where do you see that part of our industry going over the coming years?
Yeah, there's, I think, some underlying themes that maybe aren't fully appreciated sort of broadly in the marketplace. Yes, there's a lot of PE money, and yes, there's a lot of acquisition activity. Back to sort of innovation, I think we were probably the first business to really think about the TPA market in a different way. But sort of this was our investment thesis as a company. We see a very fragmented market of sort of more regional based or locally based operators that, by the way, do like tremendous work for their clients day in and day out, and have great advisor partnerships and really strong platform partnerships with the record keepers. But we're suffering from a lack of institutionalized technology, service and operating disciplines, hence an inability to really scale their operations successfully, meaning an inability to deliver a consistent and a broad set of solutions nationally, which, oh, by the way, would be increasingly valuable to all of their record-keeping partners that are struggling with their own cost structure, looking to serve the small business market more successfully with the TPA model, and expecting more of TPAs in terms of their ability to really shoulder the plan-related, sponsor-related activities in administering a defined contribution plan. So that's what really drove our belief in the opportunity and the desire to not only make acquisitions, but very quickly integrate those acquisitions into a common technology platform, which we built, purpose-built platform of workflow, compliance, and other services, and a very consistent set of service and operating disciplines, so we could deliver probably the broadest set of different capabilities and services, and do that on a consistent, high quality scale level with our partners. And by the way, that's not easy, and I wouldn't suggest to you for a moment there weren't bumps and bruises right, through the early days of that evolution. But, thankfully, we're in a very different place today, right, than sort of the early years of that work. But what we're finding now that we are the largest TPA partner of every one of the record keepers that has a focused TPA model in the small mid-market. And we see certain of those partners that are even more interested today in further integrating our technology together to create more integrated experiences for that marketplace, where our partner does what they do best and what they can deliver cost effectively, and we're doing what we do best and what we can deliver cost effectively. And that's back to one of your big themes around these partnerships in the ecosystem. I think the TPA market has a lot of opportunity for more of these strategic partnerships of much more deeply embedded capabilities. And if you think about any one of these record keepers that maybe had to work with 1,000 or more TPAs on an annual basis with different data protocols and different onboarding schemes and different communication protocols, now being able to work with, I'm not saying they're all just going to work with Ascensus. That's never going to happen. Wouldn't expect it to. But if you could be working with a shorter list of more highly integrated TPAs that can deliver those services at scale, that's a pretty big deal for the record keeping community. Now, what I think everyone needs to be careful about, and I think private equity investors have learned some hard lessons in some other markets, where this view of, well, if we just buy things and let them continue to run, we can get scale and ultimately a higher multiple for that business as we sell it some number of years down the road. I haven't seen that model be really successful on an ongoing basis, because you've got to have the underpinnings of a really successful business model, the right technology, the right integration to create real value. Otherwise, it's just multiple arbitrage. And I just don't see the market as excited about multiple arbitrage these days.
Right.
So again, David, you've given us such great kernels of wisdom. I love the whole thought about the flight to quality, the flight to value, doing it easily and affordable, and kind of the key aspects that you talked about when new ventures think about going to market, being enterprise ready, and your perspective on all of these things and the TPA market is really interesting. Thank you very much for your time today. We really appreciate it. I feel like we learned a lot. It was a great episode for us. And thanks again for your time. For all those listening, please be sure to subscribe and share.
Thank you both. Yeah, really, really fun way to spend the afternoon.
Good.
Thanks, David.
Decoding growth isn't just talk, it's insight, action, and shared wisdom. If today's episode resonated with you, share your insights and join the conversation. Subscribe, rate, review, and spread the word. Thanks for listening. See you next time.